So both Mansa-X funds performed really well in the first quarter of this year. The Kenya Shilling Fund returned 4.74% for the Q1'2026 results, compared to 4.71 in the last quarter of 2025. So these are remarkable performance given the circumstances. So we are very happy about that. The dollar fund returned 2.88% for the first quarter of this year, compared to 3.24% in the previous quarter. It's slightly less, but still an annualized return for the dollar fund in excess of 11.5% and almost 19% for the Kenya Shilling Fund. The AUM also grew considerably to close the quarter at about 153 billion shillings combined for both funds. The number of investors under the Mansa-X funds also increased by about 16%, from about 55,000 investors to close over 64,000 investors under the Mansa-X umbrella. So all in all, very good performance from the fund in the first quarter of 2026, and really a positive way to begin the year for the Mansa-X funds. We saw a lot of things change, not only just from a market's perspective, but also from a geopolitical perspective. But just starting with markets, we saw a lot of fund managers, including ourselves, do a lot of rotation from technology stocks, the ones that are just purely AI stocks, into assets that you call halo stocks. Essentially, these are assets. These are stocks which refer to companies with heavy assets and low obsolescence. And an example here would be consumer staples companies. So essentially companies that would not be affected by the rising AI and technology. So even for ourselves as a fund, we moved into a lot of stocks that were not completely dependent on the technology sector. So there was a rotation into that. We also saw concerns about tariffs continue. The biggest thing we saw was actually the Supreme Court terming the tariffs illegal. And now, of course, the new conversation is, if they were illegal, can companies be able to be refunded for the tariffs that were collected from them? So that continues to be an interesting conversation on the tariffs front. So we are keeping a close eye on that. And again, that was something that affected markets in the first quarter of 2026. So the beginning of 2026 had all these matters going on. We also had a lot of concerns about the private credit sector. In fact, that was one of the biggest news out of the first quarter of 2026. In fact, with some funds that manage private credit investments actually trying to stop, withdrawals from those funds. So there's a bit of a concern there, and it continues to play a factor in the markets, because again, a lot of technology companies rely on private credit to actually continue funding their growth. So it's something that we are keeping a close eye on, and we will continue to keep a very close eye on in Q1 of this year. Then, of course, from a geopolitical perspective, we saw the Iran war. Now is the biggest thing that's causing a lot of anxiety globally. And of course, the biggest effect, the biggest asset class that is affected is oil. We saw Brent hit a high of 120 against, in dollar terms. So this is one of the things that we are closely monitoring, because of course higher oil prices will probably mean an effect on interest rates moving forward, and it also disrupts our idea of what inflationary numbers were and what they are now projected to be, and moving into the rest of the year. So Q1 was a very interesting one. From a precious metals perspective, again, we saw the highest levels we've ever seen. Gold reaching as high as more than $5,500 an ounce. These are the highest levels we've ever seen gold being valued at. Silver followed very closely, hitting as high as $121. So this also benefited the fund a lot, because of course, if you've been following what we do here, precious metals continues to be one of the top holdings in our portfolios, both for all the Mansa-X funds. So this contributed considerably to the returns as well. But moving forward, we'll also be looking at things like the Iran war and the effect on supply chains. One of the things that is coming out very strongly is the Straits of Hormuz being blocked essentially, which then affects the entire shipping corridor. And the ability for suppliers to actually deliver their products on time, meaning oil prices go up and every other item essentially going up. So this will continue to be one of the reasons why natural gas prices will continue going up, and even a product like helium, which of course having been one of the key products in the production of the semiconductors, means that of course chip making becomes also a lot more of an expensive affair. 2026 began with a lot of things going on, and we can't really outline all of them in this video. So I'd really recommend for investors who are very keen and inclined on knowing what happened and how we as a fund handled Q1, please read the fund manager's commentary on our global markets report that we always publish every quarter. This gives you a lot more detailed explanation as to what happened in Q1, how we handled that, and from whatever happened, how then the return that you earned as an investor, how was that extracted in spite of the volatilities that we saw in the first quarter of this year. But again, as we always say, please note, a volatile environment does not necessarily make it worse for investors in terms of returns. Sometimes for a fund like ours, in fact, most times it actually is important for us to have volatility in markets. It's because from that volatility, that's when we're able to get a return from for investors. We find a lot of opportunities within those volatile moments. So if as an investor you see a lot of volatility in markets, you should relax and know that this could actually be a better outcome for you. It's one of the best reasons actually to be invested in a multi-asset strategy long short fund like Mansa-X. So we can go through the top 10 holdings of both funds, the Mansa-X Kenya Shilling Fund and the Mansa-X Dollar Fund. These are also outlined in the fact sheet that you will receive from your financial advisors as well. And it's very important for you to understand that when we say top 10 holdings, we don't necessarily mean the ones that performed the best. We just mean the ones that from a percentage of the portfolio, these were really the top 10 in terms of percentage size. That's the first thing. The second thing is, when we say something was our top 10 holdings, doesn't necessarily mean that it was a long position, meaning that we only benefited if the price went up. Within our top 10 holdings, sometimes we hold assets that were short positions, meaning that the value dropping is actually how we were able to make a profit from that asset. For the Kenya Shilling Fund, our top 10 holdings, the top two are fixed income instruments. So this refers to government securities, Euro bonds, for example, US treasuries, German bonds, and so on. Both of them combined, just the underlying fixed income assets and their derivatives were about 17% of the fund. Then the third largest asset class that we were holding was actually crude oil, who about 2.2% of the fund was in crude oil, and crude oil jumped almost over 75% in the first quarter. So this was a very good play for us. The fourth largest one was actually Family Bank Limited. So this is actually buying shares into Family Bank through the OTC market, and we owned about 1.5% of the fund was in Family Bank shares. And this from the OTC market, the valuation is actually higher by 50% since we bought the stock. So this has been a very good play for the fund. And this again demonstrates we are not only in funds or instruments that are domiciled outside of Kenya. Mansa-X is what we call a multi-asset strategy fund, meaning that we can invest in assets anywhere in the world as long as they make sense from a portfolio management perspective. So we invest in also Kenyan stocks the same way we would invest, for example, in any other part of the world. So Family Bank comprised about 1.5% of the fund, and again was a real winner for the fund. Most of the stocks that were top 10 were really just structured around the geopolitical tensions, the Iran war. So you'll see the fifth, top holding was ExxonMobil, which is of course aligned to increase in oil prices. We had Lockheed Martin and BAE Systems. These are essentially defense stocks, both of which jumped almost 30% in the last quarter alone. In fact, a big part of that jump just been the last 2 months of the quarter. Then we were also short. So just like I mentioned earlier, we also have short positions. So Monday.com is a company that we were short in. We held about 1.3% of the fund was held in Monday.com as a short, which is actually a good move as well. The stock dropped about 53%. The rest was cash and NASDAQ, which we were holding a long position. About 1.2% of the fund was in NASDAQ. So this was a long position, although NASDAQ actually lost 6%. So this was actually not a profitable. So we can go through the top 10 holdings of both funds, the Mansa-X Kenya Shilling Fund and the Mansa-X Dollar Fund. These are also outlined in the fact sheet that you will receive from your financial advisors as well. And it's very important for you to understand that when we say top 10 holdings, we don't necessarily mean the ones that performed the best. We just mean the ones that, from a percentage of the portfolio, these were really the top 10 in terms of percentage size. That's the first thing. The second thing is, when we say something was our top 10 holdings, doesn't necessarily mean that it was a long position, meaning that we only benefited if the price went up. Within our top 10 holdings, sometimes we hold assets that were short positions, meaning that the value dropping is actually how we were able to make a profit from that asset. Like the Middle East and Asia, just under 4%, and the Oceania region. So this fund is not just diversified from asset classes that we hold, but also geographically where those assets are actually traded out of and also held through our various custody accounts across the world. If you look at the dollar fund, the composition is very similar. You'll see fixed income instruments being the top holdings, crude oil futures, ExxonMobil, Kinder Morgan. Kinder Morgan is a natural gas player, and natural gas is one of the highest price movement assets in Q1 because of the Iranian war. So Kinder Morgan itself as a stock jumped almost 25% in Q1. We also hold stocks in BAE Systems, which is a defense stock, and Lockheed Martin in the dollar fund. We also short Nike. Nike actually lost value over 17% in Q1. And just like the Kenya Shilling Fund in the dollar fund, we were along the S&P 500. Just slightly over 1% of the fund was in S&P 500, but S&P 500 lost value about 4.72%. So this was a losing position, but we held it as part of our top 10 holdings in the portfolio. So just to explain what this demonstrates, if you look at the total holdings of the top 10, for the Shilling Fund, you'll see the total holdings total up to 30% of the fund. The total holdings of the dollar fund is slightly the same, slightly higher than that. It's about 31% of the fund. So the remaining 70% is in so many other assets, but the percentage holding is much smaller. I say that to just emphasize the diversification of Mansa-X. You have so many asset classes that even your top 10 don't exceed a third of the fund. And this is one of the reasons we tell our investors to have a lot of comfort in knowing that the fund takes diversification very seriously as a risk management strategy and continues to protect the downside due to just the sheer number of asset classes that we trade at any one time. From a geographical perspective, the dollar fund was very similar, except now the top holdings were in Americas and Europe, about 56% for America and 27% for Europe. The rest was Africa, Middle East, and Oceania. For Africa, of course, dollar-denominated Euro bonds are the bulk of that holdings. So again, all this information is available in the fact sheet that you receive from your financial advisors. And we advise our investors to take their time to go through that fact sheet because it's really a summary of the strategy for the fund for the first quarter of this year. And anything that you don't understand, please reach out to your financial advisors for more guidance. Thank you. So moving into the second quarter of 2026, of course, based on what has happened in the first quarter of this year, we go in, of course, cautious and very keen on what happens in the Iranian war, what's happening right now between the US and Israel and Iran determines how the geopolitical landscape looks like. And from there, we are able to then determine how markets, how we're able to know how markets then react to this. That's really the biggest thing moving into the second quarter of this year. But just to put things in perspective, we haven't actually seen markets behave drastically. To put things in context, last year when markets were concerned about tariffs, we saw a drop of almost 20% in markets, about 19%, which is bear market territory. That was just last year with the anxiety around the tariffs. This year, even after the Iranian war, started, the biggest drop we saw in markets has only been 6%. And even as we speak now, markets are only down 3% since. So essentially, they've recovered. So markets have become quite resilient to some of these factors. So we continue to be very hopeful. And again, there's also every indicator that there'll be some sort of, even if not a ceasefire, some sort of lull in the war, which again allows markets to recover. Another thing that we'll be looking at is central bank action moving forward. So before the war started, one of the things we expected the central bank to do was actually cut interest rates. But now moving forward, we might actually see a pivoting from actually cutting interest rates to holding interest rates as they are as the best option. Then the worst option, we might actually see some central banks actually might raise interest rates, mostly due to oil prices-led inflation. So that's something we'll also be very keen on. So this drastically changes the outlook of interest rates, not just globally, but also locally, where we expect the easing cycle by our own central bank to take a pause due to concerns about the future inflation as pushed up by the oil prices. So we'll be watching that very closely. But in terms of earnings, company earnings, this is one of the factors we use to determine the health of the market and whether we should still be invested in companies. Of course, last year we had very good guidance by a lot of companies as to how the earnings would be. We expect that this year the earnings will continue to grow as they did. We've had 6 straight quarters of double-digit earnings growth. We expect this to continue even into Q2. But we'll wait to see how company earnings will then be affected by the current situation. But we believe that it's going to be very positive. Another thing we'll be watching very closely is the action by AI companies, especially in their CapEx spending. But when we started 2026, AI companies had approved over $600 billion worth of CapEx spending. So of course, you can imagine this is a rising tide that lifts all boats. So we'll be waiting to see whether there's going to be any change in that CapEx spending. But as we speak, we don't really see that changing. Chip companies, as you know, we actively hold companies like ASML, NVIDIA, and AMD. So we'll be continuing to see how chip companies will continue, whether they can sustain their pricing. One of the things that was actually a very interesting thing that happened in Q1 was Qatari natural gas manufacturing areas being hit by the Iranian war, which affected the production of natural gas. Now, helium is a byproduct of the production of natural gas, and helium is critical in the manufacturing of chips. So again, this affects the whole supply chain and production line for chips. So we'll be waiting to see how that affects it. I mean, Qatar is a third of the world's helium comes from Qatar, which again goes to countries like Taiwan and South Korea that are the biggest chip manufacturers. Again, that's an area we'll be watching very closely. So Q2 will be a market that we expect will be affected by geopolitical tensions, but in terms of volatility and in terms of the swings we have seen in markets, we have seen way worse than this before, whether it's what happened in the tariffs last year or what the geopolitical tensions in Russia and Ukraine before that, COVID before that. And again, this is one of the reasons we are constantly telling investors that the real reason why you should be invested in a fund like Mansa-X is because the fund essentially is designed to navigate volatile markets of this type. Locally, we'll be watching what the CBK does. I guess what's on everybody's mind is whether the shilling will actually be able to sustain oil-led inflationary pressures. So we suspect the shilling might lose a bit of value, but we believe the central bank has more than enough reserves to defend the exchange rate. If you look at the central bank reserves, they are over $13.5 billion. These are really some of the highest reserves we've ever seen the Central Bank of Kenya holding, which is over 5.8 months of import cover. So we believe that no matter how dire the situation gets, the central bank can actually defend the local currency. So we are going into Q2 cautious, but still optimistic that the way the fund is designed, we are still able to continue delivering returns for investors and, more importantly, protecting the downside as well. We'd really want to thank our investors. As I always say in all my videos, we totally appreciate, the faith, the trust that our investors have in our products. Our Mansa-X products have grown, in leaps and bounds because of the support that we receive from you, our investors. We don't take it lightly that you entrust us with your life savings. This is something that we take very seriously, and everybody here at the Mansa-X team and here at SIB, we take our jobs very seriously. So not only do we try to give you a return, one of the key things we always look out for is a downside. We are constantly ensuring that we do not create any dent in our investors' funds. So that's something that you can rest and sleep well at night, knowing that that's one of the things that we are consistently having our eyes on. So as we move into the rest of the year, there'll be a lot of headlines that can be scary to any investor. I can imagine for an investor who is not really conversant with the markets, seeing news about markets, being volatile because of what's happening in Iran and any other things that might come up from that war. That might be very concerning for investors, but it's at that moment that you should remember that that's the main reason that you're invested in a fund like Mansa-X. It's specifically designed to be able to navigate volatile markets, not just to give you an outsized return, but to just keep your money safe when conditions are actually not very they're not very easy to make returns out of. So that's exactly what this fund is designed for, and you should be comfortable in knowing that you're really invested in the right place. We will also have our AGM on the 30th of this month, 30th of April 2026. And we encourage all our investors to attend that AGM. You can ask a lot of the questions that you might have. One of the formats we are changing is in this AGM is to allow more time for investor questions. That's one of the feedback we got from our last AGM, where investors say they would like to ask a lot more questions during our AGM. So we will allow that. We'll allow more time in the AGM for this year, to sufficiently address any concerns that you might have. So I'm looking forward to hosting you for that AGM, and between now and then we continue to encourage our investors to remain steadfast and comfortable in that their monies are well invested in Mansa-X, and their returns should continue to grow their investments.